Good afternoon, everybody. For those of you who I don't know, my name is Bob Rasmussen, and I have the honor of being the dean here at the Gould School of Law. And it is my distinct pleasure to welcome Larry Summers to the Gould School of Law. And it really is a challenge, though. Which Larry Summers do you introduce? Right? Can you introduce Larry Summers, the public servant? This is a man who has served in 3 different presidential administrations, first working as staff in the Reagan administration and the Council of Economic Advisors. He then also did a stint as the chief economist for the World Bank. He spent 8 years in the Clinton administration, serving ultimately as the 71st Secretary of the Treasury. And then, during the Obama administration, he was the director of the White House National Economic Council. So we could just talk about him as a public servant. But then we also have Larry Summers as the academic superstar. And probably the most depressing thing, this is a conference on tax, and still I find this is the most depressing thing I've heard all day. He was tenured at Harvard at the age of 28. You know, I felt so bad. You know, in 1987, he was the 1987, he was the first social scientist to win the Alan T. Waterman Award from the National Science Foundation. In 1993, he was awarded the John Bates Clark Medal. And for those of you who aren't economists, this is a BFD. This is, to quote a famous vice president, this is an award given out every other year to the best American economists under 40. And in the citation, they actually recognize Professor Summers' contributions to 4 distinct areas of study: public finance, labor economics, financial economics, and macroeconomics. He also served in a small role as president of Harvard University. And he is currently the Charles W. Eliot University Professor at Harvard. So which Larry Summers do you introduce? Well, I thought about it, and I actually found this quote about Larry from Henry Kissinger. Kissinger said that Larry Summers should be given a White House post in which he was charged with shooting down or fixing bad ideas. Shooting down or fixing bad ideas. And I think that really unites both the public service side of Larry Summers and the academic side. That throughout his career, whether in public or academia, he has been courageous and ruthless and bluntly honest about attacking sloppy thinking, unrigorous thinking. And at a conference that's talking about the tax code, perhaps there are some bad ideas around that may need either fixing or shooting down. So with that, I'd like to turn it over to our guest and keynote speaker, Larry Summers.
Dean, thank you very much for those generous words. There is one thing I did learn about in political life where you have utterly failed me, and that is the management of expectations. I don't see how after those generous words I could possibly live up to the expectation that you created. I'm glad to have a chance to speak at a symposium like this. I have always thought that one of the respects in which the United States is well governed and has a system that works well relative to other countries is that the membranes between government and other parts of the society, and in particular between government and academia, are more permeable in the United States than they are in most other parts of the world. And I think we are better off for it. I know that the work that I did at the Treasury and then oversaw from the perspective of the NEC was made substantially better by the knowledge that had been produced by those in tax academia. I know that students who spent several years, or young faculty who spent several years of a career in the Treasury working on tax law, made a very great contribution. And so this sense is something that I think is very, very important. I think that taxes are actually an area where, as a country, in this respect, we may do relatively well. There is a very broad problem in an increasingly complex society, that there are many subjects where it is extremely difficult to find disinterested expertise, because there is very little reason to develop expertise unless you have an interest. Consider, for example, the intricacies of derivatives. Why would you know about the intricacies of derivatives unless you were going to trade them and do things with them and basically thought they were good? Why would you be in the field of nuclear engineering if you didn't kind of basically believe in nuclear power plants? And in an increasingly complex society, that is a problem. And it's a problem in the tax area. And one of the very important mitigants in keeping the process honest is the tax academics who know the details, understand the intricacies, and don't have major client interests that drive their convictions. So the enterprise that this conference is bringing together is one that I think is extraordinarily important. If I had a grand plan for what should happen to the US tax code over the next 10 years, it would be entirely appropriate to use my 20 or 25 minutes to detail that plan and explain the 7 reasons why it was terrific. I do not, however, have such a grand plan. And so perhaps in the spirit of the kind words of Henry Kissinger that you were good enough to quote, what I thought would be best was to make 5 observations that seem to me to be very important as we think about the debates that will go forward about the future of the code and to defend them. First observation: the public sector will get larger in the United States over the next 15 years, and the revenue share of GDP will increase. Yes, it will matter how well Democrats do and how well Republicans do in elections, how much that happens. But there are 4 broad forces that are operative that will overwhelm the transient political fluctuations. First, we are getting older as a society. On any definition of retirement age, the fraction of those who are retired to the fraction of those who are working will be 50% higher in 2030 than it has so far in this century. And that means that as a share of all the income that is earned, the cost of those programs will be substantially greater than it has been historically. Social Security, it's all simple because there's no good you're buying whose relative price changes. It's about 1% of GDP for Social Security. Medicare is about the same size. So the demography is at least 2% of GDP. Second, we have more debt. If we had the most terrifically austere and effective fiscal policies going forward, and we did not have any economic adverse consequences from those policies, the debt GDP ratio in 2020 would still be above 70%, compared to an average over the last 40 years of some number in the 30s. Twice as much debt means twice as large an interest burden. That too is on the order of perhaps 1.5% of GDP. Third, and most fundamentally, the structure of our economy is changing. Relative prices are changing in ways that pressure the size of government. I am probably the only person in this room who's ever curled up in bed with the compendium of CPI statistics. It's actually not bad against insomnia. But here's something I found that actually did keep me up. Do a very simple thing. They normalize all the prices to be 100 in 1984. And you can look at the price of different things right now. The price of television sets, remember that's 100 in 1984. The price of television sets was 6 in 1984. Excuse me, is 6 today. The price of a day in a hospital room is about 600. The price of a year of tuition is about 700. In other words, the relative price of television sets and hospital days has changed by a factor of 100. Now, I chose those things to make a really strong point. I could have chosen computers, by the way, and it would have been even more dramatic. But if you choose services and durable goods, it will be a factor of 2.5. Governments buy many more things like hospital rooms and college educations than they do like television sets. And so if you want what you want, the share that you're going to have to pay of the economy is going to be substantially larger. Fourth, government is involved in activities related to redistribution and the provision of social insurance. And we are becoming more unequal as a society. 1%, top 1% of our population now earns about 25% of all the income. It used to earn about 10% of all the income. In the 1960s, 1 out of 20 men between the age of 25 and 54 was not working. When the economy has fully recovered from this recession, it will be 1 out of 7 men between the ages of 25 and 54 who will not be working. That's going to mean that there's more government transferring. Now, you can argue that some of the reasons for that are that there's too much government transferring, and whatever the incentive effects, it is just hard to believe descriptively that a society that is becoming substantially unequal is not going to have pressures that are going to drive more spending. So the first suggestion that I would have is that as we think about tax reform, the basic overall thrust of tax policy over the next 15 years is going to be that we are going to need more revenue than we have right now. Second observation. The income tax is going to be profoundly challenged by the increasing perfection of capital markets and the increasingly effective liquefaction of a broad range of transactions. In the days when tasks were all done within command and control organizations, it was mostly clear what was labor income and what was capital income. In a world of free agent, independent contractors establishing their own entrepreneurial ventures to provide services, those distinctions between labor and capital income come to mean much less. In a world where more and more is tradable, the options associated with realization become more and more valuable. Warren Buffett has famously explained the injustice associated with the fact that he, as he measures things, pays taxes at a 35% rate in contrast to his secretary's, at an 18% rate, in contrast to his secretary's 35% rate. But there's a higher truth. The higher truth is that Warren Buffett's net worth is in excess of $40 billion. That we can probably safely assume that that $40 billion is, on average, invested rather effectively, and that 5% of $40 billion is $2 billion, and that his tax bill is on the order of $20 million. And so there are vast amounts of what is really income that is escaping taxation. This is a group that will know more complexity in this area than I do. Governor Romney's IRA is a suggestive example. It is generally believed that that was achieved by placing an out-of-the-money, as officially valued, option into his IRA so that it did not exceed the contribution limit. But when life worked out well, it turned out to have vast value. This is not the place to discuss in detail the role of minority interests in estate planning. But the point is that before we get to fundamental base broadening, there are vast gaps between deriving the capacity to have substantial net worth and the measurement of income under our current income tax that are not even counted as tax expenditures. There is, I think, a deep discussion to be had as to whether this represents a solvable problem or whether this is a profound flaw in the income tax model. My view is that substantial progress could be made with a combination of stepped-up basis repeal of stepped-up basis at death and its replacement by constructive realization, along with proper accounting for accrued gains on liquid securities, along with proper valuation of options for tax purposes, along with reform of the estate tax. I don't know whether I would endorse all of the proposals. I suspect not. But the impulse behind Professor Calvin Johnson's work seems to me to be one that should be emphasized. And of course, movements in this direction have the benefit of achieving substantial increases in progressivity, as well, I believe, as substantial increases in revenue, and quite possibly substantial increases in efficiency by making the structuring of transactions for tax purposes less worthwhile. But it seems to me that the glaring issue around the income tax is not the tax expenditures, which for the most part can be debated but have constructive social purpose, but is these issues that relate to the measurement of income. Carried interest is the currently visible tip of a vast iceberg of the problematic that should be pursued in subsequent reform debates. Observation 3. A certain caution is appropriate around the conventional, widely advocated, lower the rates and broaden the base agenda. Yes, all good academics are in favor of broadening the base and lowering the rates. However, it is important, I think, to qualify one's enthusiasm with 3 caveats. First, in the years ahead, there's going to need to be more broadening of the base than there is going to be of lowering the rates, given the revenue imperative that I spoke about. Second, the argument as it's usually made is an analytic half-truth. Imagine, to take just one example, that you eliminated the charitable deduction and used the revenues that you generated to reduce marginal rates. The way the argument is usually made, you have produced an improvement in incentives, and people are likely to work harder and put forth more effort because they have lower marginal rates. But a moment's thought should reveal that that is basically wrong. If I work and I spend 80% of what I earn consuming and 20% of what I earn on my deductible charity, then the actual marginal tax rate in terms of what I want to do is 80% of my stated marginal tax rate. If you rearrange things in a way that is revenue neutral for me, but has the effect of raising the tax on charity, you do not change my weighted average marginal tax rate at all. I mean, the most obvious example of this is when people say it's going to be great, we're going to stop the deduction of state and local taxes and reduce federal marginal tax rates. Let me think about it for a minute. What presumably matters for my effort decision is my overall marginal tax rate. And so what you gain in federal revenue, you lose in the state tax being more burdensome. So the argument that broadening the base reduces marginal rates in some important way that encourages work and saving and economic activity is wrong. The case has to be that the deductions are operating to encourage things that shouldn't be encouraged. It's only the distortion between the favored activity and the non-favored activity that constitutes a legitimate distortion to be concerned about. And then the question is, how compelling are those arguments? Since charity has at its essence being a gift to somebody else, it seems to me hard not to recognize that there's some positive externality associated with my giving to USC rather than my buying a car. So I think the case is almost non-existent. With respect to state and local governments, the argument isn't clear, but to the extent that they're engaged in the provision of public goods, it's far from clear that you're not subsidizing something that you want to encourage. There probably is an argument, if you believe there are not externalities associated with home ownership, for limiting the mortgage interest deduction. And the issues around the tax treatment of health insurance are complicated. But it is far from clear in a society that has just made a major objective of causing there to be more health insurance that the efficiency gains are vast from removing a support program for health insurance. So on balance, broadening the base in lowering the rates is, I think, the right thing to do, and the general run of tax expenditures almost certainly should be curtailed. But the economic efficiency gain is much less than it is usually argued to be. And the gains that you will realize, there is no reason to think will show up either in a higher measured GDP or in a higher level of employment, or be responsive to the economic concerns that figure in the tax debate or in most of the political debate. It may be that we will have a society that produces goods that are better matched to people's preferences. But the idea that somehow this will, by creating incentives, drive substantially increased economic activity, it seems to me is supported by neither theory nor evidence, starting from our current low level of marginal tax rates. So I'm for it, but I think the case is overdone. Observation 4. Taxing things that as a society we wish to discourage is an underexplored and understudied area of the tax law. I have not done a systematic study, but my guess would be that there are 35 times as many law review articles written over the last decade on the proper measurement of capital income as there are on the merits or demerits of taxing the emission of carbon dioxide, the consumption of sugar, the use of congested highways, the use of advertising to encourage products that are not desirable, or any number of examples that could be conceived. Now, to be fair, the advocates in this area make essentially the same fallacy that I just criticized a moment ago. It is very common for advocates of carbon taxes to explain that we should tax something that's bad, carbon, rather than something that's good, work, and to forget that when people buy gasoline with their work and you tax carbon, you are taxing work. And so in its crude form, the argument is wrong. But it seems to me there are a variety of activities on which there is a very substantial social case for active government measures to reduce, to bring about reductions, and that the use of price instruments would have the virtue of generating revenue. To take one example, we are imposing in a very rigid way fuel economy standards on the automobile industry. We say that every car company has to meet some set of rather complicated rules about its average fuel economy. You might suppose that in a market economy, just like there's some publishers who are good at romance novels and there are other publishers who are good at textbooks, that there'd be some car companies that would be good at big cars and other car companies that would be good at little cars. And so requiring them all to have the same fuel economy would seem manifestly inefficient relative to the alternative of taxing big cars if there's a feeling that big cars are harmful. And that has the additional virtue of raising revenue. So my hope would be that there will be much more study, and as a consequence of that study, I believe much more advocacy of approaches to raising revenue that run through efforts to discourage things where there is a social consensus that they should be discouraged. Last observation is that if I had to guess in what area will the tax law, for better or for worse, change most fundamentally over the next 25 years, it would probably be in its international and global dimension. We have an odd system of corporate taxation in the United States right now. We proudly, in many quarters, tax global income and do not have a territorial system. And then we allow deferral, which means that for the most part, we don't actually tax global income. And we do what is almost always a mistake in the tax law. In the tax law, if you are making people really unhappy and not getting money from them in substantial quantity, it means that you have very likely designed the rules in an inefficient way. Because it means that there is a way of making them happier and having them pay for the fact that you're doing it, so they are equally happy or slightly happier, and you generate more revenue. And that means addressing deferral. It probably means, if you're going to successfully make the deal, doing it in a way that is neither the preferred way of the left, which is deferral, it's terrible, it's a subsidy to outsourcing and all that, we just got to tax everybody totally on everything, nor the preferred way of the right, which is to move entirely to a territorial system, but is some form of arrangement in which you move to a territorial type system, but back it up with some kind of minimum tax on global income. That, it seems to me, is reinforced by another consideration, which is that the fraction of international trade that takes place within companies is increasing and is expected to increase substantially in the years ahead. It used to be remarked that a Boeing airplane was produced in each of 435 congressional districts, at least one component. Increasingly, it's true that there are products that are produced in a significant fraction of the UN's 200 members. In that world, I don't think the good guys are ever going to win the battle on transfer pricing, on the location of debt and costs, on the valuation of royalties and licenses associated with intellectual property. And so just as at a certain point, every state taxes its citizen corporations on their global income, or just on their local income, became a non-viable arrangement, I think something like that is in the way to happening with respect to income earned abroad. I emphasize this last point, even though it is somewhat smaller and more technical than the first 4 points, because I think the viability of corporate tax reform hinges on being able to do something constructive that is both revenue raising and business friendly in the corporate international area. If you can't do that, and so it's only about lower rates and less accelerated depreciation and less incentives for R&D and less incentives for this industry and less incentives for that industry, everything I know from my political experience suggests that the beneficiaries of the lower corporate tax rates will neither be as enthusiastic nor as noisy as the losers from the base broadening measures, and that it will be very difficult to put together an appropriate political coalition. So just to sum up, international, I think it will get to a very different place over the next generation than where it is now. Taxing negative externalities or things that are harmful as a revenue raiser that also serves constructive purpose should, it seems to me, be a major area of investigation by academics in the years ahead. The traditional things we all talk about on base broadening represent a constructive impulse but probably a somewhat exaggerated constructive impulse, rather than those who are relative to what those who are still channeling Stan Surrey tend to argue. That there's an important role for experts around the definition of capital income. Look, there are only two ways this is going to get, that set of issues will ever get fixed. One is what FDR did when he appointed Joe Kennedy. FDR appointed Joe Kennedy as the head of the SEC. And when asked why, he explained that it takes a thief to catch a thief. And that's one approach. The other approach is to find dispassionate expertise of the kind that the tax law academic community represents to think through these very difficult problems associated with capital income. And last, the arguments I made suggest that if Justice Holmes was right when he said that taxes are what we pay for civilization, that the price is likely going up. And we're going to have to pay more taxes. And that's going to make making the tax system more important, work better, more important than it's ever been before. Thank you very much.
All right, well, I'm Ed McCaffrey. That's amazing that you ended with a call to raise taxes and got an applause line. Brilliantly done. And I want to thank Mr. Secretary Larry. Not only those are tremendous comments and very thoughtful for coming here, but also for his pledge of the fair market value of a car to USC. We're taping it, so that's a binding pledge. I want to say a very quick shout out to my own work. I have a piece coming out in Tax Notes calling for a repeal of stepped-up basis on death now that we don't have an estate tax. And maybe you'll get on my bandwagon for a progressive consumption tax in which I define the high-end spending of the rich, which they can do even because they can borrow against their unrealized depreciation. That's my negative externality. But we'll save that for another day. Before we move on here, I just have to take 1 minute. Just explain to everybody in the room, we are here for a birthday party. It is the 100th anniversary of the ratification of the 16th Amendment. And we are really here because Nancy Stout, our wonderful professor, incoming vice dean, has done just a tremendous amount of work. So we would be wrong not to shout it out. And now we are honored and privileged. What we're going to do, we're going to move to another USC colleague. We also have Tom Griffith. We have wonderful tax faculty here, Ed Kleinbard. And a lot of things that Secretary Summers was talking about are things that Ed Kleinbard, when he was in practice, when he was inside the Beltway in an important position in DC, now that we are delighted to have him be a member of our academy, has been talking about tax expenditures, capital income, corporate tax reform, global tax reform. Ed's going to have 5 minutes, which is going to be very difficult for Ed. Then we're going to move to Pat Kane, who's an honorary one of us because she spent some time visiting here at USC. She's now at Santa Clara, one of the leading international experts on the issues of same-sex taxation, same-sex marriage, and just a wonderful scholar of the income tax generally. Pat's going to get 5 minutes, and then we're going to end at 6, come hell or high water, but we're going to throw it open to questions. I have a list of questions, including in this political environment, how do you think academics like yourself can have any long-term impact? These are questions that came from Nancy, Professor Stout's income tax students here at USC, so I have some of those. But without further ado, the inimitable, with further ado.
Can I just say, you all are very fortunate to have Ed Kleinbard. He really made a difference during his time of service in Washington. And I suppose he illustrates what would be kind of a corollary to something I said towards the end, that another way of getting a better tax law is to find a former advisor to thieves and turn them to the other side.
All right. With that, Ed Kleinbard.
Now I have to revise my So, I am very honored to be sitting up here with Larry. I've had the pleasure and privilege of sitting across from him when, in fact, I was an advisor to Thieves and he was Secretary to the Treasury. And I was a senior advisor to the securities industry. I had the pleasure of working with him in the very dark days of early 2009 when he was at NEC and I was up on the Hill. Larry has a reputation that you may have heard that precedes him for being blunt and incisive. The reason for this reputation is that it's true. I'll give you a very quick example because it relates to the kind of points I'm hoping Larry will touch on. One solution, because if you take a step back, Larry's remarks really go to the idea that we need to raise more revenue. And the first place that academics latch on when you say that is a value-added tax. To give you a sense of what happens when you ask Larry a question like that, a well-meaning academic at a meeting I was at once did say, when are we going to have a value-added tax, Mr. Secretary? And Larry replied that the problem with a VAT is that Republicans know it to be a money machine for the government. Democrats understand it to be regressive. But when Republicans figure out that it's regressive and Democrats latch on to the fact that it's a money machine, then we'll have a VAT. So those are the kinds of answers you can expect. Larry's speech, again, was extraordinarily well organized, and I just think what this man could have done if he had notes. Right? I mean, it was extraordinary in its clarity. It raises 1,000 interesting questions. But I'd like to suggest that for those of us who are interested in the world of tax, that we focus on, in pestering Larry, trying to tie him down a little bit more on this fundamental question of where's the money going to come from. He's made a powerful case that revenues must rise. There are only a handful of possible sources. One is the personal income tax. And there you might say that Larry kind of maybe made it a little easy on himself by talking about rate reduction and base broadening. The question might be posed, what about just base broadening, and in particular, the tax expenditures, the personal itemized deductions that Larry listed, are those a useful, fruitful source of pure revenue? They're very, very large in amount. There's business taxes, and there we have to confront two problems. One is that the headline US corporate rate at 35% is just way out of line with world norms. And at the same time, we have $1.6 trillion in offshore earnings of US multinational firms that sort of trapped by virtue of our arcane system. Larry talked about this at great length. His particular proposal for a territorial tax with some anti-abuse rules is kind of undercut by his own identification of some of the fundamental problems, that transfer pricing is insoluble, that the location of intangibles is insoluble. Those kind of questions might point in the opposite direction of worldwide tax, but with a lower rate. And finally, you got personal income tax, you got business income tax. We're not going to do it all on the basis of alcohol and cigarette taxes. So the only thing that's left is new taxes. You're welcome to ask Larry about the value-added tax, but I've tried to give you a warning. And that leaves only two others. One is the carbon tax that he's touched on briefly. And the final one, which in many ways is the most interesting, is financial transactions tax. Larry and I remember, but nobody else does, that he wrote an article on this very topic, circa 1980 or so, called the Securities Transfer Excise Tax. I ghost wrote a rebuttal on behalf of the securities industry. I'm sure it didn't trouble Larry at all. But the interesting thing is that the financial transaction tax has now returned and is in fact being adopted in Europe, ex the UK. And the fair question is whether a financial transactions tax should be part of the portfolio of revenue-raising measures that we look at in addressing the revenue requirements that Larry's laid out.
Are you done?
Yes, I'm trying to be.
Wow.
I left out the capital income
Wow.
stuff because if
Wow.
I start on capital income, I just
Wow.
wouldn't stop. I just wouldn't.
So these are just amazing things that you've come in under 5 minutes. That's very impressive. But thank you, and there are lots of stuff we can, Ed's really out there writing a lot. There's lots of stuff that's happening here. So we'll move to Pat Kane for her.
Thanks,
5 minutes.
and I'll be brief. I too was incredibly impressed, especially with the no notes. And every topic that you touched on, I think, was addressed in some way during the panels today with all of the tax academics. So we're all concerned about these issues. We all think that the tax law needs to be more equitable. It needs to do something about this distribution, really bad distribution of wealth between the very wealthy and the very poor, and the middle class just seems to be going on one side or the other. And we're also very concerned about having a tax that is simple enough that people can understand it and that it can be administered fairly. I think some of us would prefer more market neutrality, except perhaps for taxing the bad things. And I think we're all in pretty much agreement that we need to broaden the base. You mentioned Professor Calvin Johnson. I can't help but take a minute. I started my career at the University of Texas, where Calvin is, and I was there for about 17 years, and I take the credit, or some would say the blame, for bringing Calvin to Texas. What he's doing, for those of you in the audience who are not familiar with his work, he's kind of become a one-man think tank on various ways to broaden the base. Get rid of personal deductions, except I worry that we'll get rid of them too quickly for me, since I am poor enough to have a mortgage and pay mortgage interest deduction, but I'm happy to support transitioning away from those deductions. He wants to broaden the tax base, of course, by bringing in all of the kinds of income that we don't tax right now, the imputed rental value on your home, for example. So all of that is very interesting. I do think you're right, that we need more academic input. There's no way we can get this Congress to change the code. It's almost like you have to tear the whole thing up and start over. And it seems to me that there ought to be some way to get tax academics, in fact, real tax people with experience with the tax code, who know how it works out there in the world, together in some kind of blue ribbon panel that will actually help make the tax law more fair, take care of the inequality problems, broaden the base. And so one thing I'd just be interested in hearing from you, is that feasible? Is there any way, what is the best way to go forward in trying to make that happen?
All right, and Larry, did you want to, those are wonderful questions, so do you want to take some time?
I'll try to be relatively concise. I always thought there are different ways that academics influence policy processes. One way is they develop expertise as academics, and then for some portion of their lives they are in the system and they use their expertise to do a good thing. Another way, and that certainly in the case of some academics, that's an important one. Another way they do it sometimes is they're what we in the White House used to call validators. The administration wants to do something, and it's right, and there needs to be a force behind it, and so there's mobilization of experts to speak and testify and write in favor of it. I actually think, in some ways, the most perceptive comment I've heard about how academics as academics are really influential was a discussion that Milton Friedman once gave. Now, I don't agree with Milton Friedman about much on the substance, but Milton Friedman's view was that he and people like him didn't really have any comparative advantage in figuring out what was going to be appealing in getting 34 votes in the Ways and Means Committee. And that was best not their concern. What they needed to be doing was to have an inventory of worked out good ideas, so that when the mood changed and there was a desire for a certain kind of idea, those ideas were there to be provided. And so you're not going to pass in the next year any kind of carbon tax or any kind of spiffy environmental anything. And you're not in the next 5 years going to pass, I would guess, any kind of price instrument to do fuel standards of the kind that I talked about. But the world changes. There'll come a moment when, 15% of the ice cap melts in a summer rather than 2%, and then everybody will want to do something. And we'll get to a much better place if there are people who know what to do. And so I think the way to think about it is you're the force of academia thinks. Academia thinks X, therefore I'm a public servant, and academia is dispassionate expertise, and I will do X. That's likely to be a frustrating model for academics to operate on because public servants are not likely to buy in. But what public servants have is they have a kind of broad directional impulse, and then they look for expertise as to how best to act on that impulse. And what that impulse is changes over time. And so I think that's probably a very important part of conceptualizing what the role of the kind of writing and research that we all do as academics. Ed, I'm not sure I've been on all sides over the course of my 25 years in this of the transactions tax. I did write an article, as you know, advocating it in the late 80s. I have become much less confident that that view is right than I was at that time. There are more feasibility questions than I recognized at that time. I think more fundamentally, I think the arguments that making markets illiquid or less liquid make them better are, with the benefit of more study and hindsight, less persuasive and less likely than I thought they were at that time. And I think what has not been fully worked out, or really sort of worked out at all to my satisfaction, although I actually suspect it's a problem that analytical research could make progress on, is what is the incidence of transactions taxes? Is it that if the government collects $25 billion a year, the people who run hedge funds will make $25 billion less a year because they transact in markets? If you put turnover, I would be inclined to think that if the government put a stamp duty on houses, that whenever a house is sold, 3% is going to have to be paid, that a lot of the impact of that would be that the price of houses would somehow be lower, because down the road there were going to be all those taxes paid, and that was going to get capitalized into the value of existing houses. Would the tax be borne by all the holders of stock then? And would that be a particularly good thing to do? It seems to me that a judgment on a transactions tax has to depend on a more nuanced theory of incidence than has yet been developed. There's a lot of money made in hedge funds, but there's a lot of money made in private equity, which suggests that, and a lot of money made in real estate, which suggests that the idea that the inequality is centrally related to the high frequency isn't compelling. And there's a general idea that goes back to Diamond and Murley's that it's usually bad to tax intermediate goods. And somehow turning things over is a kind of intermediate good. So, on the other hand, Hong Kong is pretty successful given the kind of city that it is in being a financial center. And it raises about $3 billion US with a stock market that's about a seventh the size of the US stock market, which, people think capitalism's functioning okay in Hong Kong, which suggests that some of the things you wrote, you no doubt wrote in criticizing my paper, were probably more apocalyptic about this than may have been fully warranted. So all that leaves me not ready to endorse, but with a certain amount of ambivalence. I think the measure income better, stepped up basis is about 25, constructive realization instead of stepped up basis is $25 or $30 billion a year. So that's 300 over 10. That's not small, 250, 300 over 10. That's not small relative to the stakes in the discussions that people have. So I think there's a fair amount in that. I don't think there's any harm, and I think in some of the areas it's probably a good thing in scaling back some of the tax expenditures. I just think you're kidding yourself if you somehow think raising rates is gravely damaging to the economy and scaling back tax expenditures doesn't have fairly similar kinds of impacts. But I think some of that is what you will end up doing. Where I'm either confused or unclear or misunderstood you, or possibly you misunderstood me, is that I think I'm not sure we're for different things. It seems to me that if you say we're going to have some kind of minimum U.S. tax on the global income of U.S. companies, whether they defer it, whether they don't defer it, wherever they earn it, it seems to me that operates as at least some significant mitigant with respect to the transfer pricing problem, because even if they transfer it to Ireland or someplace, your 15% minimum is going to apply to it. So I guess that was the kind of idea that I had in mind in my comment.
I guess you're moving away from territorial. That's a step away from territorial.
It's a new halfway house.
Right.
It's still a split rate, because in fact the floor will become a ceiling in practice. So.
Well, I'm just getting this little vibe as we get towards 6 o'clock that the tax wonks are getting a little too tax wonky, and we're going to open it up. We're going to open it up. That does not mean Dan Shaviro gets to ask the first question. We're going to open it up and ask some questions. One thing on the colloquy between Larry and Pat in terms of the time frame. The Tax Relief Act made permanent changes, so we have at least 6 months, is my understanding. It's like a California marriage, is my joke on that. But now before we open it up, we are being taped. We have these wonderful assistant women here, Candace and Diana, who have handheld microphones. So if you have a question, I'll acknowledge you, and then we'll get you there. I do want to say, because we have these wonderful things from students, here's just one. We'll start off with the student question. What is one thing you wish the American public was well educated on with respect to economics or the tax code? One thing you wish the American people would know. And maybe we'll start lining up a question while you...
Economics? I'll give an economics answer because I don't have an obvious tax answer. Imports are the reason why you can buy so many toys for your children. And they're the reason you can afford your wardrobe, and that protectionism is mostly a problem, not because it hurts businesses, but because it makes people's incomes lower because they can't buy as much with it.
There you go. All right, so I've been told I have to sit down because I'm too tall, but I'm still, hands up. Let's go over there with Kirk Stark from UCLA, and then we'll have Nancy. And so Kirk, go ahead.
I just want to go back to this notion of you cuddling up with the CPI compendium and the relative price changes over the, because that's very striking, these examples that you give. And I wonder to what extent, if at all, is the tax system to blame for some of the changes in relative pricing of bundles of consumption over time? And I'm thinking specifically here of the kinds of things that you identified: healthcare, education, to some extent housing. Certainly all of those things are things that enjoy very substantial tax preferences in the Internal Revenue Code. Is that in any way partly to blame for what's going on with changes in relative prices over time, or are those just minor effects that are overwhelmed by larger structural forces?
My judgment would be there are minor effects that are overwhelmed by larger structural forces, and but it's not like I know. My reasons for having that judgment are 100 to 1's kind of immense, A. B, I can sort of see the structural forces. Moore's law is, semiconductors cost half as much every 18 months, is kind of potent for television sets, and it'll sort of always take a psychiatrist an hour to do a 1-hour appointment. Is kind of potent, or a law professor 2 hours to do a 2-hour seminar for 12 students is kind of potent, limiting productivity growth on the other side. So I see the structural forces as large. And third, over the long run, I would tend to think that the relevant supply curves were quite elastic. And so even if tax is moving the demand curve, if everybody's taste changed, and if nothing about technology changed, and over a 25-year period, everybody's taste changed, and they wanted more television sets and less education, or more education and less television sets, I wouldn't particularly think that should be a thing that would move the relative price of televisions and educations that much when we're talking about a 25-year period. So I'm inclined to think that taxes are not the answer.
I think we have to go to Nancy Stout, who paid for these microphones, largely paid for these microphones, so she gets to ask a question.
Thank you very much. I loved your comments. Your ideas on raising taxes and focusing on taxing labor and capital correctly, focusing on the basis step up, focusing on these bad acts sounds great, but it doesn't seem like we're going to eliminate our need for additional debt. So what I want to know is, do you think it's just easier to issue debt, and what are the national implications of that, national security implications specifically of going that route for paying for public goods?
As a general proposition, at most times and places, if I'd had to give 2 economic lessons that the public needed to understand, the second of them might have been that issuing debt is not an alternative to cutting spending or raising revenue. It is a way of postponing doing those things while increasing, because of interest, the amount of them that you have to do. So I don't think you can sort of avoid having to, there's a budget constraint that the present value of what you spend has to equal the present value of what you tax, and you don't kind of avoid that by issuing debt. I think that at the present time, we're in a liquidity trap. The interest rate is 0. It's substantially less than the growth rate of the economy. The economy is demand constrained. There's actually a quite compelling case, while the private sector is deleveraging, for the government to be doing some leveraging in order to support the level of demand. You know, Kennedy Airport's a national disgrace. And if you ask when should it be fixed, and it's going to be fixed sometime. I mean, it will be fixed sometime. And if you ask when should it be fixed, it sort of feels like it should be fixed at the moment when the real interest rate is negative for 15 years, and at the moment when the construction unemployment rate is in double digits. So, and by the way, when you don't fix it, you're taking on a liability that you don't measure, but you are taking on a liability. So I think right now we need to be very careful about overdoing austerity, even as we do address the long-run problems. I am less anxious than I think many others are on the borrowing hurts our power in the sense that somehow our creditors will do us in, because I think our creditors will find it extraordinarily expensive and disruptive to themselves to attempt to do us in. I used to be more concerned. I used to frequently talk about how Eisenhower basically pushed Britain and France out of Suez in 1956 by saying there were going to be no more loans to support their currencies, and they basically gave way. And gosh, that's a problem with being heavily indebted. And then it occurred to me subsequent to my saying that maybe that was right. I mean, it is right historically about Suez, but it was probably relevant that at that moment, U.S. holdings of pounds and francs represented about 0.25% or 0.5% of U.S. GDP. And so if they went down by 20%, it wasn't really a big deal. Whereas Chinese holding of external debt is, for many countries, holdings of reserves are 20, 30, 40% of GDP. And so doing something that was disruptive was also vastly more expensive for them. But look, at a certain point, it's sort of hard to believe that the world's greatest borrower stays the world's greatest power. Since I think right now we're probably under-focusing on, as an immediate matter, on the jobs and growth deficits, and over-focusing on the budget deficit, that wouldn't be my primary concern at this instant.
All right, well, I made fun of them, but I love them. And we have from NYU, from New York, the bastion of Wall Street power, Dan Shabiro. And Dan has a question for you.
You discussed the financial transactions tax, but I think your former co-author on that piece is the International Monetary Fund, and they've been proposing something called the financial activities tax. So I was wondering, which is sort of a net tax on financial sector firms with kind of a multiplicity of rationales and different design ideas. Do you have a view on the FAT?
There's some irony in all of this. My former, some people are laughing because they know what I suspect most people in this room don't know, that my former co-author is also my former wife. So I could have made we get along fine, but I could have made a crack about, well, she wrote, that was her views, and I could have made a set of cracks along those lines. I think it's fair to say that the IMF, the job of the IMF is to be responsive to its member governments. And so its member governments were looking for ways of taxing the financial sector. And some of the enthusiasm for the FAT came from the fact that a general tax on the value added of the financial sector, which is in essence what I think a FAT is, might be better than taxing one particular function of the financial sector namely the turnover of securities. And I don't have a strong view on it. I think you can get yourself to a case by saying that in some value-added taxes, the financial sector is in effect exempt, and a FAT is kind of coming close to bringing neutrality to the financial sector, which is a good thing to do. But I think we have a lot to figure out around how to think about externalities and the like associated with the financial sector, where there are many different effects, but to just mention two that's sufficient to point out that it's ambiguous. There's the argument that if I invent a better mousetrap, I'm richer and you're all better off. And if I figure out a good system for figuring out who's going to win the 7th race at Churchill Downs, I'm better off, and all the other people who are playing at Churchill Downs are worse off. And so a lot of this stuff that goes on around the financial sector is kind of trying to win a zero-sum game, and you're better off tamping down on it. That's one set of arguments. There's another set of arguments which are that there are all kinds of things that become 3 times as valuable when a liquid market is created for them. And that a lot of what goes on in the financial sector involves creating that liquid market, and that is performing a valuable service. That after all, one of the things that high-frequency traders do, the things they do that may not be so great, but one of the things they do is that when Larry Summers comes along and wants to sell 1,000 shares of XYZ company, the price doesn't fall very much, because if the price was going to fall very much, all those high-frequency traders would be rushing to get there and stop it from falling. And so their competition creates a fair market. That's sort of the benefit of liquidity. So you can argue these things in both directions. My instinct is to be more comfortable with FATs than with financial transactions taxes. Another way of thinking about why I have that view is that, you know, a FAT is going to be an X percent, where X isn't a huge number, tax on all the income derived in the sector, or all the value added derived in the sector. A transactions tax is likely to be a 50 or a 75% excise tax on the activity of transacting. And so in general, our tax law intuitions would tell us that, despite the skeptical comments I made before, if I just told you you were wading into an area that you didn't understand very well, and would you rather put 5-10% excise taxes on 5 different activities, or would you rather choose one of them and put a 50% excise tax on it, you would incline towards the 5-10% taxes. And I think the FAT is closer to that.
Plus, it might pass as an anti-obesity tax as well. So I think discretion is the better part of valor, because these questions are so wonderful and the answers are so thoughtful. We're not going to get them done in the next 2 minutes. I know, among other things that Mr. Secretary Summers has on his plate, there's a concern of some snowstorm coming to Boston. So I want to thank Nancy. I want to thank all the audience here, Bob Rasmussen, our sister schools of Marshall and Price, who really chipped in and helped out, Ed Kleinbard, Pat Kane, and most of all, the inimitable Larry Summers.